Join us right now to talk on set about the markets and the new all-time highs. Gabriela Santos is here, Chief Market Strategist for the Americas at JPMorgan Asset Management. Good morning to you.
Good morning.
So do the highs beget new highs, or does the highs beget some reconsideration about where to go next?
So over time, we do see all-time highs beget new all-time highs. So over the next decade, we do expect annualized returns of 7%. So that means we should spend a lot of time on all-time highs.
You're going to tell us about the next decade. That's great. Okay.
No, but truthfully, I think in terms of the very short term, right, as Mike was just pointing out, a lot of this has been driven, again, by the Magnificent Seven. So it'll very much depend on what we get out of earnings that start next week, not just in terms of the fourth quarter earnings from these big tech companies, but most importantly about the guidance for this year, where expectations are already pretty high. If you look at the multiple, their concentration in the index at all-time highs, can the earnings actually catch up to their weight in the index? So that's at the overall level. What we're most excited about is actually the equal weight index or all those other sectors. And it will depend on right-sizing some of these expectations around growth without inflation and rates coming down.
So to the extent that you're telling people to rotate, how are you telling them to do so?
So first off, we're fine-tuning how we talk about investing in stocks, right? Specifically, we spent all of last year talking about the Mag 7. Well, they're 7 individual companies, right? We like some of them more than others. The second thing is to think more broadly about this AI theme. Last year was about pricing in the first winners to monetize this transformative technology, but this can start to sprinkle through to other winners, and especially looking at not just hyper-cap tech, but large cap, mid cap tech. And you started to see that late last year. We're just doing some consolidation here. We're also really excited about other sectors. Sectors like healthcare, whether it's cyclically or seeing parts of medical services picking back up, which really suffered during the pandemic, or GLP-1 drugs and the huge transformative effect. We also like industrials. You're seeing huge industrial policy, plus more spending on defense. And lastly, utilities. Kind of a boring defensive stock, but discounted, and actually with some pretty exciting long-term trends,
but given just the volume, or at least the number of folks who I'm sure are watching us who own the Magnificent Seven, what are you telling them to do?
We're telling them to look at them very, very carefully on a risk management basis and think, do I want 33% of my U.S. equity exposure on just these companies? And do I actually prefer some of them more than others? So to actually think about it actively rather than just receiving that passively.
And how would you answer that question if we put all 7 stocks on the board right now?
So we do like some of them very much. I'm not allowed to talk about
You're not allowed to say which ones?
No, I'm not an analyst, actual corporate company
analyst. She is an analyst, folks.
So
She's just
I'm not allowed to publicly mention company names. But we do like, actually, 4 out of the 7 quite a lot. And so we would want to actually overweight them versus others that we would want and prefer to underweight. And it's exciting this year. You're actually seeing more of a differentiation between them than you were last year.
You like 4, but you can't tell us which 4?
It's like a secret. It's a real problem.
I don't have the license that allows me to tell you.
Would it be,
as JPMorgan
would it be in hindsight
the
4 that do the best 6 months from now? Were those the ones you liked?
No, our portfolio managers
But you do like
forward.
4. But they have to tell us, or you have to kill us if you told us?
I'd have to.
Tomorrow, can you have one of your colleagues come on and tell us about which 4?
Yes, we can.
Oh, we can organize that?
We can organize
Could they message you right now?
My people talk to your people.
Okay.
They can't message you right now to tell you what? No? Okay.
I do know which ones they are.
They could give you dispensation. I could give you dispensation right now. Separately, though, in terms of your expectation of what the Fed really does and how that's going to impact everything.
Look, I think the market gets excited. You kind of overprice rate cuts. Really, the Fed is going to start very gradually. They're just talking about fine-tuning, cutting nominal rates to keep real rates stable. And then down the line, we don't think this year, but next year, maybe the year after, as you start to see the economy softening, then they start to pick up the pace of rate cuts. But every investor we talk to, whether it's March, May, June, is just fine-tuning in the short term. Ultimately, we're talking about being on the other side here, rate cuts, and that's much more of a favorable environment for bonds, for stocks, and it really increases the opportunity cost.
But when do you think all this happens?
We're thinking more mid-year. That's probably when, especially the inflation data, would give them enough ammunition. This Friday, we get PCE for December, 6-month annualized.
GDP coming, I think, on Thursday, right? Wednesday, Thursday?
On Thursday, I believe. Wednesday or Thursday.
Yeah.
And really, the data this week is set to confirm what we got everybody excited late last year, which is that you can have growth. Right. GDP, we expect at 2.4%, at the same time that you actually continue seeing disinflation. So we're right to be excited about rate cuts. It's just in the short term, it can drive some noise on the short end of the curve about when it begins.
Do you not fear that the rate cuts are only going to come if things are worse?
No, because I do think that was the most important thing Chair Powell acknowledged at the December meeting. It's okay. We can have growth and continue to see disinflation. Structurally, nothing has changed in this economy that makes inflation sticky at 3%. We don't have a wage price spiral. We don't have inflation indexation in this economy. So why wouldn't it normalize with growth at trend at 2%? Okay. And we think we'll be there in the middle of the year.